The gold market just crossed a line that Wall Street doesn't want you to see. 48 hours ago, while the mainstream financial media was busy telling you that everything is fine and the economy is strong, the U.S. Treasury bond market sent a signal so powerful that it rewired the entire precious metals equation overnight. In a single trading session, gold ripped back above $5,050 an ounce. Not because of speculation, not because of hype, but because the underlying economic data just confirmed what the forensic research team here at With John AG has been warning you about for months. The American economy is cracking beneath the surface, and the smart money is flooding into the only assets that have survived every monetary crisis in the history of human civilization: gold and silver. Before we break down exactly why the data released this week changes everything and why silver in particular is setting up for the most explosive move of the decade, make sure you subscribe to the With John AG channel right now, because the information in this video is the kind of institutional grade analysis that the big banks charge tens of thousands of dollars for, and we are giving it to you for free. Hit that subscribe button and the notification bell, because in the next 45 minutes I'm going to show you the exact forensic evidence that proves we are entering a precious metals supercycle that will redefine wealth for an entire generation. Let us start with the data that dropped this week, because this is not just another economic report. This is the crack in the foundation that the entire house of cards is built upon. The U.S. Census Bureau released its retail sales data for December, and the number came in flat. Zero growth. The market was expecting a 0.4% increase. Instead, it got nothing. Now, the mainstream media will tell you that flat retail sales is no big deal. They will tell you it is a one-month anomaly. But the With John AG forensic research team sees something entirely different when we dig beneath the surface of this number. What we see is the American consumer, the engine that drives 70% of the U.S. gross domestic product, running out of fuel. This flat reading came after a 0.6% rise in November, which means the momentum is decelerating rapidly. Consumers cut back on motor vehicles. They cut back on big-ticket purchases. They are telling you with their wallets that they cannot afford this economy anymore. And when the consumer stops spending, the entire GDP growth narrative collapses like a house built on sand. But here's where it gets truly significant for gold and silver investors. The moment that retail sales data hit the wires, U.S. Treasury bond yields dropped like a stone. And this is the critical transmission mechanism that every precious metals investor needs to understand. When Treasury yields fall, the opportunity cost of holding gold and silver, which are non-yielding assets, drops with them. This makes precious metals dramatically more attractive relative to bonds and cash. It is not just theory. It is the mathematical reality that has driven every single major gold rally in modern history. Lower yields equal higher gold. And the yields are not just dipping. They are signaling something much more profound about where this economy is headed. The money markets are now pricing in 58 basis points of Federal Reserve easing throughout 2026. Let me translate that into plain English for you. The bond market, which is the smartest and most ruthless market in the world, is telling you that the Federal Reserve will be forced to cut interest rates significantly this year. Not because they want to, not because inflation is conquered, but because the economy is weakening so fast that they have no choice. This is the exact environment where gold doesn't just go up 10 or 15%. This is the environment where gold goes parabolic. The With John AG analysis of every rate-cutting cycle in the last 50 years shows that gold's average return during a sustained easing period is north of 40%. And this time, the starting point is already above $5,000 an ounce. Do the math. A 40% move from $5,000 puts gold at $7,000. And that may be conservative given the structural forces at play. Now let me walk you through exactly what happened in the market this week, because the price action is telling a story that most people are completely missing. Gold traded back above the $5,050 mark in the Asian session on Wednesday. The COMEX gold contract hit $5,081.96 per ounce, up a full 1% in a single session. But the real story, the story that has the With John AG forensic team on high alert, is what happened in the silver market. Silver exploded 2.3% higher on COMEX to $82.20 an ounce. On the MCX in India, silver jumped nearly 3%, hitting 259,418 rupees per kilogram. This is not a random move. This is the silver market telling you that the monetary earthquake is coming, and silver is positioning itself as the asset that will capture the most violent upside when the tectonic plates finally shift. The technical picture on silver is extraordinary, and the With John AG chart analysis team has identified a pattern that historically precedes explosive breakouts. Silver is currently trading near the upper boundary of a descending wedge pattern on the daily chart. For those who do not follow technical analysis, a descending wedge is one of the most powerful bullish reversal patterns in existence. It means the selling pressure is exhausting itself, and the buyers are getting ready to overwhelm the sellers. The 14-day relative strength index on silver is sitting at 47, right in neutral territory, and it is ticking higher. This means the momentum is stabilizing and coiling like a spring that is about to release. Silver is holding above its rising 50-day exponential moving average at $79.91, which confirms that the medium-term trend is still bullish and the underlying demand is real. The With John AG technical team has identified $84.50 as the critical breakout level on silver. Once that upper wedge boundary is reclaimed, the measured move target from this pattern points to a level that will shock most investors. We are looking at a technical target that could send silver screaming toward $121.66. That is a 47% move from current levels. And when silver decides to move, it doesn't walk. It sprints. Let us talk about why the US dollar is weakening and why this is the rocket fuel that gold and silver need to reach escape velocity. The greenback has been undermined by dovish signals from the Federal Reserve, and the money markets are pricing in continued easing. But there is a much deeper and more disturbing force at work here. The issue of Federal Reserve independence has been thrust into the spotlight, and the With John AG forensic research team believes this is one of the most bullish developments for gold in decades. President Donald Trump has suggested he might sue his own Fed chair nominee Kevin Warsh if Warsh does not agree to lower interest rates. Think about that for a moment. The President of the United States is threatening legal action against the head of the central bank to force rate cuts. This is the kind of political interference in monetary policy that has historically preceded major currency devaluations in every country where it has occurred. From Argentina to Turkey to Zimbabwe, the pattern is always the same. When politicians start dictating monetary policy, the currency suffers and gold soars. Fed Governor Stefan Moran added fuel to this fire by openly stating that complete central bank independence is unattainable. This is an extraordinary admission from a sitting Fed official. It is essentially telling the world that the Federal Reserve is not truly independent and that political considerations will influence monetary policy. The With John AG analysis of this development is clear. When the world loses confidence in the independence of the U.S. central bank, it loses confidence in the U.S. dollar. And when confidence in the dollar erodes, capital flows into the only money that no government can print, no politician can manipulate, and no central bank can devalue: gold and silver. UBS, one of the most respected institutional banks in the world, has just revised its gold forecast dramatically higher. They are now predicting that gold will close 2026 at approximately $5,900 an ounce. Let me repeat that number because I want it to sink in. $5,900. That represents a 16% upside from current levels, and this is the conservative estimate from a major Swiss bank that has a reputation for being cautious. The With John AG forensic team believes that UBS may actually be underestimating the move because their model does not fully account for the tail risks that are building in the system. The potential loss of dollar reserve status, the acceleration of central bank gold buying, the explosion of fiscal deficits, and the breakdown of the global trade order. When you factor in these structural shifts, a gold price north of $6,000 by year-end becomes not just possible but probable. UBS specifically stated that their gold projection feeds into their broader positive view on commodities and that strong performances from industrial and precious metals have scope to continue. They said investors should anticipate that commodities will play a more prominent role in portfolios in 2026, with returns driven by supply-demand imbalances, geopolitical risks, and long-term trends. This is not some fringe newsletter making wild predictions. This is UBS, a bank with $4 trillion in assets under management, telling its clients to increase their commodity exposure. When the institutional money starts moving in this direction, it creates a wave of demand that retail investors can either ride or be crushed by. Now let me connect the dots on why silver is the asymmetric opportunity that could create generational wealth in this cycle. Silver has a unique dual nature that makes it the most explosive asset in a precious metals bull market. It is both a monetary metal and an industrial metal. On the monetary side, silver benefits from all the same forces driving gold higher: lower yields, a weaker dollar, central bank credibility crisis, and the flight from paper assets to hard money. But on the industrial side, silver is benefiting from the largest infrastructure build-out in human history, the electrification of everything: solar panels, electric vehicles, 5G networks, artificial intelligence data centers. All of these technologies require silver. The Silver Institute estimates that industrial demand for silver will hit record levels in 2026, while mine supply remains constrained. This creates a supply-demand imbalance that is getting tighter every single month. The With John AG forensic analysis of the gold-to-silver ratio shows that silver is historically cheap relative to gold at current levels. The ratio is sitting well above its long-term average, which means silver has significant room to outperform gold in percentage terms. In the last two major precious metals bull markets, silver outperformed gold by a factor of 2 to 3 times. If gold is going to 5,900 as UBS predicts, the historical relationship suggests silver could be heading to $120 or higher. And if gold overshoots to 6,500 or 7,000, which is entirely possible given the macro setup, silver could touch $150 an ounce. From current levels around $82, that represents an 80% gain. This is the opportunity that the With John AG channel exists to bring to your attention. The inflation data due on Friday is the other piece of this puzzle. If inflation comes in hot while the economy is slowing, we enter the dreaded stagflation scenario. Stagflation is the worst possible environment for stocks and bonds, but it is the best possible environment for precious metals. Gold rose over 2,300% during the stagflation of the 1970s. Silver rose over 3,600% during the same period. The With John AG forensic team is not saying we will see identical moves, but we are saying that the structural setup today is remarkably similar to that era. Massive fiscal deficits, political interference in monetary policy, supply chain disruptions, energy price shocks, and a loss of confidence in the currency. History does not repeat exactly, but it rhymes. And right now, it is rhyming with the greatest precious metals bull market in modern history. Let us address the elephant in the room: central bank gold buying. This is the structural force that has fundamentally changed the gold market, and most retail investors still do not fully appreciate its magnitude. Central banks around the world have been net buyers of gold for over a decade, but the pace of buying has accelerated dramatically since 2022. Eastern central banks in particular, led by China, India, Turkey, and Poland, have been adding to their reserves at a record pace. They are diversifying away from U.S. treasuries and into physical gold. This is not a short-term trade. This is a multi-decade strategic repositioning that reflects a fundamental loss of confidence in the dollar-based financial system. The With John AG forensic analysis of central bank reserve data shows that this buying is likely to continue and even accelerate as geopolitical tensions rise and the BRICS nations develop alternative settlement systems. Every ounce bought by a central bank is an ounce that is permanently removed from the market. This structural demand floor under gold is unlike anything we have seen in the modern era. The With John AG research team has also been tracking the gold ETF flows, and what we are seeing is the early stages of what could become a tidal wave of institutional and retail demand. As real U.S. interest rates decline, the opportunity cost of holding gold ETFs drops, making them more attractive to portfolio allocators. During the last major easing cycle, gold ETF holdings increased by over 50%. We are in the early innings of a similar cycle, and the inflows have barely begun. When the passive money starts flowing into gold ETFs, it creates a self-reinforcing cycle where higher prices attract more inflows, which drive prices even higher. This is the virtuous cycle that took gold from $1,000 to over $2,000 in the 2011 cycle. This time, the starting point is $5,000, and the macro drivers are significantly more powerful. Now, I want to talk directly to you, the individual investor, because this is why the With John AG channel exists. The mainstream financial media is not going to tell you to buy gold and silver. They are funded by advertisements from brokerage firms that make money when you trade stocks. They are incentivized to keep you in the equity casino, where commissions flow and assets under management grow. But the forensic data does not care about advertising revenue. The forensic data tells the truth. And the truth right now is that the risk-reward setup in precious metals is the most favorable it has been in over a decade. You have declining yields supporting the price floor. You have a weakening dollar providing a tailwind. You have central banks providing structural demand. You have the Federal Reserve trapped between inflation and recession. You have political interference threatening the independence of monetary policy. You have UBS and other major institutions raising their price targets. You have the technical charts showing bullish patterns ready to break out. And you have a retail investor community that is massively underweight precious metals relative to historical allocations. Every single one of these factors individually would be bullish for gold and silver. Together, they create a convergence of forces that the With John AG forensic team believes will drive one of the most significant precious metals rallies in history. The platinum and palladium markets are also confirming the broader precious metals thesis. Platinum rose 0.6% to $2,098.78, while palladium gained 0.2% to $1,712.25. These metals are more industrially focused than gold, but their price action is confirming that the precious metals complex as a whole is being lifted by the macro environment. The With John AG view is that a rising tide is lifting all boats in the precious metal space, and the boats with the most sail area, gold and silver, will travel the farthest. UBS made another critical observation that I want to highlight for the With John AG community. They said that investors holding large positions in gold with significant unrealized gains should consider diversifying their commodity exposure by adding assets like copper, aluminum, and various agricultural commodities. This advice is significant because it acknowledges that the commodity supercycle is not limited to precious metals. It is a broad-based repricing of real tangible assets relative to paper financial assets. The With John AG perspective is that gold and silver should remain the core holdings because they have the monetary premium that industrial commodities do not. But the UBS recommendation confirms our thesis that we are entering a world where hard assets outperform paper assets for an extended period. This is a secular shift, not a cyclical trade. The technical levels that the With John AG team is watching on gold are critical for understanding where we go from here. Gold needs to decisively break above $5,090 per ounce to confirm the next leg higher. We are currently just below this level, and the price action suggests that a breakout is imminent. Once 5,090 is cleared, the next resistance zone does not appear until the 5,200 to 5,300 range. Beyond that, the path opens up toward UBS's year-end target of 5,900. On the downside, the With John AG analysis identifies strong support at $5,000, which should act as a floor on any pullbacks. The buy-the-dip mentality that has served equity investors well for the last 15 years is now the correct strategy for precious metals investors. Every pullback toward 5,000 is a gift from the market. The With John AG forensic team will be here to alert you when those opportunities arise. The hawkish remarks from regional Fed Presidents Lori Logan and Beth Hammack this week failed to strengthen the US dollar. This is an incredibly important signal that most people missed. When hawkish Fed speak cannot lift the dollar, it tells you that the market has already moved beyond what the Fed is saying and is trading on what the Fed will be forced to do. The failure to bolster USD bulls despite hawkish commentary indicated that gold is likely to continue its upward trajectory. This is not our opinion. This is the market telling you through price action what it believes. And right now, the market believes the Fed will be cutting rates and gold will be going higher. The With John AG forensic interpretation of this price signal is that we are in a new regime where gold is being repriced higher regardless of short-term Fed rhetoric. Kevin Warsh, the president's nominee for Fed chair, is another piece of this puzzle that the With John AG research team has been analyzing. While Warsh favors shrinking the Federal Reserve's balance sheet, he has advocated for lower rates in the past. UBS specifically noted that this should support gold even if longer-term worries about the value of the dollar abate. This is a key insight. It means that gold has support from multiple directions. If the dollar weakens, gold goes up because it is priced in dollars. If rates fall, gold goes up because the opportunity cost drops. If Warsh pushes for lower rates while shrinking the balance sheet, it creates a unique environment where monetary policy is simultaneously tightening on one axis and loosening on another. The With John AG view is that this confusion and uncertainty in monetary policy is itself bullish for gold because gold thrives in environments where investors cannot trust the direction of policy. The likely further decline in real U.S. rates that UBS referenced is perhaps the single most important variable for gold prices over the next 12 months. Real rates are nominal rates minus inflation. When inflation stays elevated but nominal rates are cut, real rates go deeply negative. Deeply negative real rates are the most powerful fuel for gold prices. During the last period of deeply negative real rates from 2020 to 2022, gold rallied from $1,500 to over $2,000. The With John AG forensic projection based on the current inflation trajectory and the expected rate cuts suggest that real rates could go significantly more negative in 2026 than they were during that prior period. If that happens, the gold price response should be proportionally larger. This is the mathematical framework that supports a move to $6,000 and potentially beyond. Let me bring this all together for the With John AG community because I want to make sure you understand the full picture. We are not looking at one or two bullish factors for gold and silver. We are looking at a complete alignment of fundamental, technical, geopolitical, and monetary forces that are all pointing in the same direction. Higher precious metals, prices, the weak retail sales data confirmed the economic slowdown. The falling Treasury yields confirmed the rate cut expectations. The weakening dollar confirmed the monetary policy shift. The central bank buying confirmed the structural demand. The UBS price target revision confirmed the institutional view. The technical patterns confirmed the bullish setup. The political interference in Fed policy confirmed the loss of monetary credibility. And the With John AG forensic analysis confirms that all of these forces are converging at the same moment in time to create what we believe will be the most significant precious metals rally of this generation. Silver in particular stands at the intersection of all these forces with the added catalyst of explosive industrial demand. The electrification revolution is not a forecast. It is happening right now. Every solar panel installed, every electric vehicle produced, every data center built requires silver. And the mining industry simply cannot produce enough silver to meet this demand while also satisfying the monetary demand from investors seeking a safe haven. The With John AG supply-demand model shows that the silver market will be in a significant deficit in 2026. When a market is in deficit, the only way to balance supply and demand is through higher prices, much higher prices. The With John AG forensic team has been tracking the flows in the silver ETF market, and what we are seeing is remarkable. Despite silver being up significantly over the past year, the ETF holdings have not yet seen the kind of explosive inflow that would indicate a mania phase. This means we are still in the early to middle stages of this bull market. The mania phase, where retail investors pile in and drive prices to unsustainable levels, has not even begun. When it does, and the With John AG forensic indicators suggest it could begin within the next 6 to 12 months, the price appreciation in silver will be unlike anything we have seen in the modern era. For those of you who have been following the With John AG channel, you know that we do not make predictions lightly. Every analysis we present is backed by forensic data, institutional research, and historical precedent. The current setup in gold and silver is the strongest we have ever documented. The risk of not having precious metals exposure in your portfolio is now greater than the risk of having it. This is a statement we do not make often, but the convergence of forces we are seeing today demands it. As we look ahead to the rest of this week, the non-farm payrolls data and the inflation data will provide the next catalysts. If the jobs data comes in weak, confirming the economic slowdown narrative, expect gold to challenge 5,100 and silver to push toward 84 and beyond. If the inflation data comes in hot, confirming the stagflation narrative, the precious metals rally could accelerate even faster as the market prices in the Fed's impossible dilemma. Either way, the With John AG forensic analysis shows that the path of least resistance for gold and silver is higher. Significantly higher. Make sure you are subscribed to the With John AG channel right now. Hit that notification bell so you never miss an update. Share this video with anyone you care about who has money in the financial system, because the information in this analysis could be the difference between preserving your wealth and watching it erode in real time. The precious metals train is leaving the station. The With John AG forensic data proves it. The institutional research confirms it, and the price action is showing it. The only question left is whether you will be on board when it departs. The data has spoken. Gold and silver are the assets of 2026. The With John AG forensic analysis is complete. Now it is time to act. Thank you for watching. Subscribe now, and I will see you in the next video where we break down the exact price levels and the exact catalyst that will trigger the next leg of this historic rally. The supercycle is here. Do not miss it.